Welcome to the Intermede Investment Partners Update. My name is Sinead Rafferty, Portfolio Specialist at NAB Asset Management, and I'm joined by Richard Thompson, Financials Analyst at Intermede. Welcome, Richard.
Hi.
So, one of the recent additions into the Intermede fund is HDFC. Can you tell us a little bit about the thesis behind that addition?
Yeah, sure. So HDFC is an Indian housing finance company. This is a market with huge structural growth prospects, and that's driven by, in part, there's low current penetration of mortgages. So mortgage debt in India represents about 10% of GDP. That compares to more than 20% in China, for example, and 60 to 80% in most developed markets. And that's supported by favourable demographic trends. So India has a very young population, 2/3 of the population are less than 35. Indians tend to buy houses quite late, so the average age of a home buyer is 38. So that gives you, 2/3 of the population, moving through that age bracket over the next, foreseeable future. So then also you have favourable economic trends in terms of the rising middle class, in terms of urbanisation, and in terms of nuclearisation of family households. So right now, those structural trends are being supported by government measures. So the government, it's one of the government's top priorities, is trying to tackle the housing shortage in India. So that's estimated at 80 to 90 million houses that need to be built in India. So the government is targeting 50 million houses to be built over the next 5 years. So if HDFC maintains its share of that, that's a huge acceleration in growth. If these 50 million houses are delivered, 20 million would be in sort of HDFC's target bracket. That could be a doubling in their growth rate. The government's also, they're trying to incentivize everyone within the housing finance chain. So they're trying to incentivize developers via tax breaks and via providing land for them to build on. And they're also trying to incentivize purchasers through tax breaks. And they're trying to incentivize the lenders through regulatory sort of changes. So all these sort of structural trends means there's a very long structural growth story for Indian housing. Now, HDFC is the best way to play that. That's because HDFC, they have significant competitive advantages. So on the asset side, it's an undifferentiated product, mortgages. So the way to compete effectively is on the cost side. So HDFC, it is the largest housing finance company. It has the most efficient cost base. And they also have the lowest funding costs. So HDFC can offer a loan on the same terms as a competitor, whilst making a significantly higher return on capital. So what we look for at Intermede, we're looking for high growth and returns on capital and to compound that growth over time. So HDFC, the market is a huge growth opportunity. They generate very high returns on capital. So it's 20% loan growth, 20% return on capital, and that compounds over time when you get this sort of type compounding in your value of your investment.
Sounds like an incredible growth opportunity. Can you tell us about your view on the market in general? There's been a lot of talk in the media. The valuations are stretched and markets are looking expensive. What's the Intermede view?
Sure, I think there are pockets of the market where we see overvaluation. I think the market in total, there are various metrics that looks expensive. Some metrics more so than other metrics. I think we focus a lot on free cash flow. So free cash flow yield of the market at 4%. It's not a huge amount away from where it has been historically. That's average 5% on average. So it looks a little bit expensive in totality. There are pockets where we think there's overvaluation, but we're very happy with the companies that we own, the valuation relative to the growth opportunity and the returns on capital. We have a very concentrated portfolio, or fairly concentrated. We own about 40 names. So we can easily avoid the pockets of overvaluation and invest in the areas where we see valuation outside.
And can you tell us about another stock in the portfolio that you're excited about at the moment?
Sure. So we have a fairly concentrated portfolio, as I mentioned, so we only have 6 stocks in financials. So I'm excited about all of those stocks, obviously. It's a very short list. So, out of all the 400 plus stocks, and I've chosen the 6 that I like the best, so I like them all. But I guess Schwab is one which is interesting at the moment. So Charles Schwab is it's a retail investment services provider in the United States. So this again it's a large market. It's 35 trillion investable assets in the US, and it's growing very strongly. It grows sort of 8 to 10% through the cycle. So Charles Schwab, they are huge. They have 3.3 trillion in total client assets, but that's only 10% of the market, and they grow. They take share consistently over time. So you've got a huge area of space in terms of market share to take over a long period of time, and that market's growing as well. So it's a huge growth opportunity for Schwab. So why is it that Schwab can take share consistently over time? The reason is the business model. So Schwab has a very intelligent business model, which is where they mix technology and human capital. So they can deliver a high quality service at a very low cost. So Schwab has what we call first mover advantage. And that is because they're so far ahead of the competition with 3.3 trillion of assets that it's almost impossible for the competition to catch them. And that's because they have the lowest, the highest operating cost efficiency, so they're able to charge the least and still make a very strong profit margin. So Schwab charges clients on average 28 basis points on client assets. Their closest competitor, their cost base is 28 basis points of client assets. And that ranges for the competitors 28 to 90. So no one can compete with Schwab. They can't charge 28 basis points because they can't make a profit at that level. Actually, most of them will be making a loss at that level. So for that reason, Schwab is able to charge the least, but their cost base is so low. They have a 40% profit margin. The peers are making 10% profit margins and charging far more. So you set that up, you've got a huge growing target market. Schwab is the preferred provider because they provide the highest quality service at the lowest cost, so they continue to take share every year. And then that's supplemented at the moment by cyclical tailwinds as well. So Schwab's revenues are very sensitive to interest rates. So US interest rates are rising at the moment, and that's a huge tailwind for Schwab's earnings. This was there was some concern about China, there was some concern when the oil price fell, inflation fell. People started to think interest rates are going to remain low forever. So for us, that was an opportunity. Schwab's valuation came right down. It was a company we've liked for a long time, so we follow it. We waited. At that point in time, the shares were very, very cheap, so we entered a position at that point. Since then, inflation and interest rate expectations have improved, and the stock's more than doubled since we bought it in 2016. But we still see a huge valuation upside, a huge growth opportunity for them over the very long term, so we continue to be holders.
Sounds like a really good story, and unfortunately we can't hear about the other four in your financial sector, but thank you so much for your time, Richard, and thank you for joining us. If you'd like to find out more about Intermede, you can find it on the website where you launched this video.